Hello all of you, I hope you all are doing good. Today we'll do the revision of accounting standard 28, that is impairment of asset. Generally students find it difficult, but very simple accounting standard, and I know that from which area of this accounting standard they ask you the question in examination. Even though we are going to cover the entire concept here, but still I will tell you which are the favorite area of ICI. They ask the question from that particular point. Okay, so there are so many things that I will discuss with you. Okay, so first is what is this impairment of asset? Not try to understand. There's some formula of it, but what is the logic behind that? When we see a balance sheet that here, okay, so there are so many assets: property, plant, and equipment, intangible asset. So they say when we depreciate PP as per accounting standard 10, correct? But certain time the value of asset goes down beyond the reason of depreciation. You say, what does it mean, sir? Let me give an example. Suppose there is a building, okay, and fire occurs that here. Because of that, the value of the building goes down. So what happened? It appears in my books of account at whatever the book value, but because of the fire, the value of the building goes down. Okay, so their recoverable amount. I will discuss what do you mean by recoverable amount. But if the value goes down, it should not be happen that the value which is appearing in my books of account, which is overvalued, that is not the actual value that is. So they say we have to book the impairment loss. There are so many reasons for the impairment loss. I'm just giving an example. To simplify it, I'm saying impairment loss means impairment of asset means there's a loss beyond the reason of the value of the asset goes down beyond the reason of what? Depreciation. For example, we are using some machinery. Okay, understand this. Now, this machinery, we import the spare parts of this machinery from, let's say, from China that here, okay. But if any fault come in that machinery, we have to import the parts from the China and then we do the repairing in India here, okay. But what happened? Now, suppose the government imposes a ban that we cannot import the spare part of this particular machinery, okay. So I cannot import the spare part of this particular machinery. So what happened that it will be difficult for me if anything happened to this machinery and to repair it that year. So obviously the value of the asset will goes down. And these are the reason which is beyond the reason of depreciation that year. So we call that impairment loss that year. Obviously there are some formula of it. I'm giving a background that year. So the logic behind this accounting standard, my value of the asset should not be overvalued in the books of account. So if there any impairment loss, we are going to reduce with that impairment loss. If you remember the accounting standard 10, property, plant, and equipment, how we present the PP in the books of account? We write it down, the value less accumulated depreciation, less impairment loss. If you go to accounting standard 10 that now, okay, if you go to accounting standard 10 that here, it is mentioned in accounting standard 10 that now how to, just give me a minute, okay, how to disclose that, okay, accounting standard 10, okay. Anyways, how to disclose that it is mentioned in accounting standard 10. And they say that here now, let me show you that. Just give me a minute that here, okay. Okay, how to present that? You can see that here on screen that now. I'm going to present that here now is the cost minus depreciation minus impairment loss, which deal by accounting standard 20. This is what we are covering today, okay. Even though you follow the fair revaluation model, impairment loss, we have to reduce that now. Now we will discuss that here. What do you mean by impairment loss and what is the concept? I already discussed with you the concept that. But it says that here now, the first is here. It says that this AS is applicable on impairment of PP and intangible assets. Impairment of asset means decline in the value of asset due to change in technology, market or economic environment, change in the government policy, okay, or the market situation. They say an asset is impaired when the carrying amount is more than the recoverable amount. Now understand, this is the key area. Most probably, I'm not saying that the other part is not important. We are going to cover each and every concept here. But the 2 points which I have highlighted here, point number 2, impairment loss. Okay, formula basically is how to calculate the impairment loss and the treatment. Here I'm going to discuss with you how to calculate impairment loss and the treatment of the impairment loss, point number 4. These 2 areas are important. Most probably ICA is going to ask a question from these 2 points. Okay, now understand what is the treatment of how to calculate the impairment loss. Impairment loss, we calculate that a carrying amount minus recoverable amount. What do you mean by carrying amount? Carrying amount means the book value of asset after depreciation and revaluation. Okay, but we are going to deduct the recoverable amount. Now the question arises, what do you mean by recoverable amount? Recoverable amount is higher of what? Net selling price or the value in use. So you will say, they say for higher of what? Net selling price and value in use. What is the net selling price? What is expected selling price of that asset minus cost of disposal? Okay, like the commission we pay at the time of sale. Now, and the value in use. Now, what is value in use? That is the present value of estimated future cash flow from continuing use of the asset and disposal. When you dispose, residual value also, we are going to get certain amount. The cash or whatever the cash we are going to receive, the present value of estimated future cash flow, including the residual value. Okay. Now, what happens? We are going to calculate the present value. So, net selling price. If we sell it today, what amount we'll get, or minus cost of disposal, like the commission. Value in use the present value of the expected future cash flow from that particular asset, including the residual value. So higher of these two, we are going to call them recoverable amount. So carrying amount means the book value after charging depreciation, revaluation, okay. Minus here, the recoverable amount. What we call them? We call them impairment loss. What we call them? We call them impairment loss, that is. Okay. This is very important. Okay. Very important. The concept that I've discussed here. In all the question, we are going to calculate from. Okay. I'm discussing the other point as well. Okay. Okay. But they are going to ask you the question from this point. And one more thing, I will treatment also that. Okay. But whatever, there are certain points we have to keep in mind that here now. Points considered. Okay. Points considered to be considered while calculating the value in use. So they say, remember these points when you calculate the value in use. Projection basis means use the most recent approved budget or the forecast up to 5 years. They say when you talk about the future cash flow from that asset, expect the 5 years. Okay. But if reliable, consider longer period also. I mean, when I talk about the future cash flow, it maximum say 5 years. But if you want to go beyond 5 years, it's okay. But this you have to show the past accurate prediction. You have to show that in past also we have done the prediction for that from that asset, it was correct. Then this okay, more than 5 years allowed. Don't growth rate, don't go over the average growth rate for the relevant product, industries or the market unless there is a good reason. Assumption, make the cash flow prediction based on a sensible and believable assumption. So they are basically saying you that when you take an assumption that when you calculate the present value, when you talk about the present value means the amount that you to receive in the future, we are calculating what is the value they have the today. So you calculate, take the proper average discount rate in the industry, use the proper maximum 5 years. Okay. But if you are taking any assumption, it should be sensible and believable assumption that you can no, all of a sudden that I know that the growth will be 10 times more. Make some sensible prediction over the cash flow they are saying. So when we talk about the cash flow consideration, inclusive and exclusion, when you talk about what it includes, net cash flow from the continuing use of the asset and net cash flow to be received or paid of the disposal of the asset. They are saying, but I'm going to say cash flow from the use of that asset and what is the residual value. If you sell that asset at the end of the life of the, how much you'll get. What we don't consider in that cash flow, the future cash outflow and inflow expected to be organizational restructuring unless the entity is committed to restructuring. They are doing the restructuring. Okay. So if you're doing the restructuring of the organization, you believe that the money will come and all that. They said don't consider it that year. Okay, unless you're committed to it. Any future capital expenditure increasing the capacity of the asset and its related saving or outflow should be. You are saying no. We have a plan after 2 years, we are going to do the expansion. Because of that expansion, the cash flow will increase. They say no, don't consider those cash flow. Cash inflow or outflow from financing activity should also not be considered. I'm going to say we are going to take a loan. Okay, we don't consider that type of cash flow from that particular asset. How much you're expecting over a period of next 5 years. That's it. Okay. Then they say there's a concept of the value in use of the foreign asset. They say suppose my asset is not in the India. Okay, it is in, suppose it's a Reliance industry. They have one branch in US and one asset is in the US. They have one building in US that is. So we how to calculate the future cash flow of that asset that is, because when value in use, what we calculate the future present value of the future cash flow. They say estimate the value in use of the foreign asset in the currency in which they generate cash flow. It means calculate the cash flow in, suppose the property is in US. Calculate the future cash flow in dollars only. Then apply the, when we calculate the present value, we have to apply the discounting rate. Okay, so apply the discounting rate of that particular country where the asset is located. And then whatever value comes at it, then convert it as per the accounting standard 11. So in class, I discussed, so okay, now here. For example, that here now, we Indian entity like Reliance, we have a building in US. Now this is the, we are expecting this much cash flow over a period of next 5 years, okay, including the residual value. Suppose this is a discounting rate that we have. Okay, this is a discounting rate that we have. In India, we have a discounting rate is 6%. In US, suppose 2%. We will consider 2% here. Okay, discounting rate. Then we calculate the present value. It is in dollar only. Now, as per then, suppose the exchange rate on the date of balance sheet, suppose 83. So we multiply by 83. This is the value in use. So what they are saying, calculate here the foreign currency discounting rate used, convert into calculate the present value in foreign currency, and then convert into Indian currency as per the accounting standard 11. Okay. Now here they say indicators. How to know that here that my asset has I'm to say how to know that here is there impairment of I'm to say if this mic is doing good, or I have so many asset, furniture, building, like that. How to find it out that here my asset is has the impairment? There are certain indicators. So there are two type of indicator. First is the external indicators, that here it means outside the organization we come to know that here there is a possibility the value of the asset goes down, or internally within the organization we come to know that within the sources of the organization I'm saying that we find it out that the value of the asset goes down. Now understand. External, they say here decline in the asset market value, decline in the asset the market value significantly beyond the expected depreciation. Suddenly that here the market value of the asset goes down. There is the chances of the impairment loss. Adverse changes in technology, market, economical, legal environment affecting the assets market. They say suddenly the market change, demand, or you can say that the technology changes from that particular asset. We are using machinery. Suddenly the advanced version comes in the market. My value of my asset will go down. Now material increases discount rate impacting the value. What is value in use? Present value of the future cash flow. So when you calculate the present value, we have to use the discounting rate. Okay, higher the discounting rate, lesser the present value will be. Okay, so if they're increasing the discounting rate, so my present value impacting it is going to impact the what value in use that here. Okay. Now they say the carrying amount exceeding the market capitalization. That's here. So they are saying the net asset carrying amount exceeds what is the market value, but as compared to that, the asset which have carrying amount with the book value, carrying amount which is recorded in the book value, it is coming that here now is the more. I mean the book value is more than the market value. So there is a chances that here there is an impairment loss, you can say. Then we have the internal indicators of impairment, evidence of obsolescence or physical damage happened to the asset. So if there's some damage happened like the fire occurs, so there's a chances of impairment loss. Discontinuation or restructuring of the operation to which the asset belongs, that particular operation we are closing down. Or internal reporting revealing the worse than expected economic performance, including higher than the budgeted cash flow for acquisition subsequent operation, actual cash flow or operating profit significantly worse than the budgeted, a substantial decline in the budgeted net cash flow, or a notable increase in the budgeted losses are increasing there. Current is the future budgeted figure indicating that operating losses or net cash outflow. Basically, these are just indicator that tell us that there might be an impairment loss that here. Okay, so external, internal, but understand is what is important that this part. Okay, this part is important. How to calculate the impairment loss? That is the carrying amount minus recoverable amount. Recoverable amount is higher of net selling price and the value in use. What is value in use? Present value, the future cash flow, including the residual value. Okay, now here is the treatment of impairment loss. This is also very important. What it says that now, it should be written off immediately as expenses to profit and loss account. Let's assume that here now, if I say I have impairment loss of suppose 10 lakhs. So how we find impairment loss? This carrying amount minus recoverable amount. Okay. Now we know, suppose fine, we know that here the impairment loss is 10 lakh that year. What accounting entry should we pass? It is a loss. Loss should be debited to P&L account. So we are going to, or decrease in assets should be credited. So we are going to pass the entry. Profit and loss account should be debited and asset account should be credited. This is the entry we pass for the impairment loss. But they say if assets are carried out at revalued figure, then the impairment loss equivalent to revalued surplus is adjusted with, and the balance if is charged to the profit and loss account. They are saying if for that particular asset you maintain a revaluation reserve account. So first this impairment loss adjusts against the revaluation reserve. If that revaluation reserve amount is not sufficient, so balance should be adjusted in P&L account. What does it mean? Now suppose there is an impairment loss of 10 lakh and we have revalued that particular asset in the past and they have a balance of, let's say, the 7 lakh. So in revaluation reserve account, I will adjust 7 lakh. Balance I will adjust 3 lakh in profit and loss account, and decrease in asset should be credited. So we credit to asset account here. So revaluation reserve account should be debited. Profit and loss account, the 3 will be debited and asset account will be credited here. Okay. In the first, if we have not revalued the asset in the past, complete loss will be charged to P&L account. If we have revalued the asset in the past, whatever balance belong to that particular asset that we have in that particular revaluation reserve account, what will do that here now? We are going to debit to the revaluation reserve account and the balance will charge to profit and the loss account. And then when we decrease in asset should be credited, will credit to asset account. Okay. Then there's a depreciate asset prospectively. This is also very important because when we pass the entry of the depreciation, this impairment, in whatever the case, we are going to credit to the asset account. The value of the asset goes down. So what about the depreciation? There is no retrospective effect as per accounting standard. They say even in case of impairment loss, I'm going to give the effect prospectively. What do we mean by prospectively? From the date we have done the impairment. After that, whatever the new value comes, revised value on which we are going to charge the depreciation over the remaining useful life of the asset. So they say depreciate asset prospectively for upcoming the years based on the new carrying amount, residual and the remaining useful life. So whatever the revised value, okay, the residual value change, the remaining useful life as per the accounting standard 10. Now the next point is recognize the liability when the estimated impairment loss exceed the carrying amount of the related asset as required by another accounting standard. Now understand this point, what they are telling us. They say, if my impairment loss is more than the carrying amount, how it can be possible? Certain time it happened that year. The value of this is, suppose, let's say the 1 lakh rupees. Okay. Now, there is no value in use of that asset because we are not expecting any cash flow, or nobody wants to purchase that also. There is no net selling price also. So what happened? In fact, to destroy that asset, law says, suppose new law comes, they say you have to destroy this asset. To destroy this asset, I have to incur certain expenses. Okay. So if I say how we calculate impairment loss, suppose the carrying amount is, let's say that here 1 lakh. How much is the carrying amount? 1 lakh. Recoverable amount is, what is going to happen that here? Recoverable amount. In fact, when I say net selling price that here, I have to incur certain expenses to sell it that year. The cost of disposal is more than the amount that I am to receive. Suppose that is coming a negative 20,000. And here it says that here value in use is 0. So they say impairment loss is equal to carrying amount minus recoverable amount. What is recoverable amount, beta? That is the higher of the two. So net selling price is negative and it is 0. So it is 0. So how much? 1 lakh minus 0, that is going to come 1 lakh. So I have impairment loss of 1 lakh. But what about this 20,000? They are saying we have to create a provision as per another accounting standard, and that is what that we call them another, as per the another accounting standard, that is the accounting standard 29. That is, this is what they are saying. The impairment will exceed the carrying amount when they say that here. What is going to happen now? My book value is 1 lakh, but the recoverable amount, when it's come to that here now, I have to add negative, that is the additional cost I have to incur. I'm not getting any amount. So for these 20,000, they are saying we have to create what? We have to create the provision that here. So we have to create a provision as per the accounting standard 29. Now, if we come to the questions that here, okay, now let's see the question on it that here. I will come to the discussion of what is cash generating unit that here, okay, what they call each and everything I will discuss with you. Now, come to Super 100 question. What it says that here now, they say Erco Industries Limited gives the following estimates of cash flow relating to property, plant and equipment on 31st of December 2021. What is the discount rate? 15%. Now, they have given us a cash flow of the next 5 years, 22, 23, 24, 25 and 26. That is 4,000, 6,000, 6,000, 8,000, 4,000. Residual value at the end of 2026 is 1,000 lakh. Property, plant and equipment purchased on 1st of January 2019 at rupees 40,000. Useful life is 8 years. And the net selling price on 31st December 21 is 20,000 lakh. There are so many things. They say calculate the carrying amount on at the end of the 31st of end of 2021. Now what happened? At what price we purchased in 1st of January 2019? So 19, 20 and what? 21. So they're after 3 years, they're talking about what is the book value. So it is purchased at 40,000. What is the residual value? 1,000 divided by the life of the asset. So if I calculate here, we purchase at what price we purchase? What happens to it? Just give me a minute. Let me charge a pencil at. Okay, very simple. I will say that now 40,000. Type in calci 40,000. minus how much is the residual value? 1000. So minus 1000, it is coming 39,000 divided by 8. So one year depreciation 4875 multiply by 3 years past, 2019, 20 and 21. So multiply by 3, that is coming 14,625. So here book value is 40,000 minus depreciation of 3 years 14,625. It is coming how much? 25,375. You can see that here the answer of first 25,375. Then they say calculate the value in use. What do we do in value? We calculate the present value. So they have given the cash flow of the next 5 years and they have given the rate of discount is how much? 15%. So you can see that here there is a cash flow of the next 5 including the residual value also. In 2026 the residual value is how much? 1000. These are the discounting it. How we calculate? 1 divided by 1.15, that is coming 0.8695. So 8.870. Like they have considered discounting rate here. Equal sign for the next year, then it will come. Then we have to multiply the cash flow with the discounting rate. Then the present value will come. That is coming 19,025. This is a value in use. So when this value in use we can now recoverable amount is higher of what? Net selling price, and what? The value in use. The net selling price is given 20,000. Value in use is coming how much? 19,025. The higher is 20,000. So my recoverable amount will be 20,000 only. Simple. Then this is the impairment law. So carrying amount minus recoverable amount. So carrying amount is 25,375. Recoverable amount is 20,000. So difference will come 5,375. That is impairment loss. Then they say revised carrying amount, means impairment also we recognize. So we recorded at 25,375 book value minus the impairment loss for the current year 5,375. So my new value of the asset is 20,000. Then they say depreciation. So depreciation we charge prospectively on the revised value. This out of it 3 years pass. So for the remaining 5 years, so that will come here. Oh, sorry, residual value also 20,000 minus 1,000 is the residual value. 20 minus 1,000 divided by 5, that is coming 3,800. Simple. Okay. Now question number 93. They say that here X Limited is having a plant asset carrying amount of rupees 100 lakhs on 31st of March 21. Its balance useful life is 5 years. Residual value at the end of the 5th year is 5 lakh. Estimated future cash flow they have given, okay, for the 5 years 22, 23, 24, 25, 26. Calculate the value in use if the discounting is 10%, also the recoverable amount is the net selling. How simple it is. Okay, so we'll calculate the cash flow for the, this is the cash flow for the 5 year. Okay, but they have to calculate residual. Okay, they have considered residual later on. Here they have write it down. Okay, no problem. Now discounting rate for 5 years, but remember that for the 5th year, for the residual value also will come for the 5th year only. Okay, because we have to sell the asset at the end of the 5th year. So we calculate their present value that here now, and this is the total present value that here, value in use. So my value in use is coming here how much? 121.92, and how much is the net selling price is 60. So whichever is high, this is the higher. So this is recoverable amount. Simple. Okay. Then here they say that here X Limited purchased a property, plant and equipment for the year ago, 4 years ago. Okay, 4 years ago, for rupees 150 lakhs and depreciate it at 10% per annum on a straight line method. At the end of the 4th year, it has revalued the asset at rupees 75 lakhs. So they charge the depreciation for how many years? 4 years. So here 150, okay, 150. And the life of the asset, they are charging 10% SLM basis. So 150 multiply by 10%, that will come 15. Multiply by 4. 150 is the value and 10% is the rate of depreciation. So what we do that 150 multiply by 10%, that is coming 15 for 1 year. So how much will be for the 4 years? That is coming 60. So 150 minus 60, this is the book value I have. Then we have done the revaluation at 75. So the book value is appearing 90. We have done the revaluation that here. We decrease the value by 15 that year. So now the new value is 75. So when we have the revalue, it is an upward revaluation. There is nothing in the revaluation reserve account. Remember, it's a downward revaluation. So entry will be profit and loss account debit to PP as per the account is 110. We are not doing the upward revaluation. We are doing the downward revaluation. Then they say okay. Now, however, on the date of revaluation, the market price 67.5 lakh and expected disposal cost of 3 lakh. So what is they say value in use or the net selling price. The net selling price there is 67.5 plus the cost of disposal 3, so it is coming 64.5. So if I say that here, what is the recoverable amount? 64.5, it's a recoverable amount and it's a carrying amount. So carrying amount is 75, recoverable amount is the 64.5. The carrying amount is more than the recoverable amount. We have an impairment loss of 10.5. 75 minus 64.5, that is coming 10.5. Simple. Okay. Now they say that here, what they say the market when the value is estimated that here is the 60. Okay, they have given the what is the treatment in respect to the impairment loss on the basis that the fair value for the revaluation purpose determine the market value and the value in use is estimated 60. Okay, they have given the value in use also 60 and this is 64.5. Okay, they have given this also. This is 60. So higher is this 64.5. So we'll take that. Okay. Now come to the next question. So most probably they have to ask you from these two concepts only, the calculation, how to calculate the impairment loss and what is the treatment of impairment loss. Okay, now come to question number 95. From the following details of an asset, find out the impairment loss, find out treatment of the impairment loss. So two things, calculate the amount of impairment loss and what should be the treatment of impairment, or they also current year depreciation. Simple. What is the cost of the asset? 56. Useful life is how many years? 10 years. Okay. So, and the salvage is 0. So, what is the amount of depreciation? 56 divided by 10, 5.6. Current carrying amount they have given. What is the today's? This is the what is the book value? 27.3. Remaining useful life only 3 years. Recoverable amount is 12, and the upward revaluation done in the last year 40. Simple. Find out the impairment loss that year. How we calculate impairment loss? Carrying amount minus recoverable amount. What is the carrying amount? They have given the carrying amount today is that 27.3. So 27.3 minus recoverable amount. What is the recoverable amount? Is 12 minus 12. So impairment loss is coming 15.3. Okay. But you will tell me, sir, charge to penal amount. Wait. In past, they have done the upward revaluation. They have in their revaluation reserve, they have 14 lakh. So out of this 15.3, 14 will be adjacent revaluation reserve and remaining will go to penal. So revaluation reserve account will be debited by 14, profit and loss account will be debited by 1.5 and asset account will be credited by 15.3. Okay, this is what they have calculated that here. Okay, simple. This is all about the question that they ask in the examination. But obviously, I am going to cover all the concepts, so you have to listen to me. Okay, the next concept is cash generating unit. What is this cash generating unit? Better that cash generating unit means if individually that asset not able to generate the cash. Okay, so when we merge the smallest group of the asset, that as a group they can generate the cash. So they say, for example, machine 1 cannot generate individually cash. So machine 1, machine 2, machine 3 will club together because as a group they can generate the cash. So we call them cash generating unit. It's a group of assets. Okay. They say here a smallest identifiable group of assets that generate the cash inflow from continuing use that are largely independent of the cash inflow from the other asset or the group of assets. So they say a recoverable amount estimation. Estimate recoverable amount for what? The individual asset. If not feasible, it means if we cannot find it out, that then we have to create the cash generate, CGU we call them. Identify the lowest aggregation of the asset. Make a group of the smallest group of assets that able to generate the cash. Now how to allocate the impairment loss? That is the problem we have. What is the problem? The reason is that here the impairment loss is not for particular asset. It's a group of assets. So let's take an example. Suppose if I say, I have three machines, machine 1, I have three machines, machine 1, machine 2 and machine 3. So we have a loss, carrying amount of 50 lakh, 10 lakh and 20 lakh. Okay. Now how to calculate the impairment loss? Suppose it's say the recoverable amount of the group. So net selling price of all those three machines is 60 lakh. Value in use of all those three machines is 70 lakh. So higher of the 60 lakh, 70 lakh, 70. So recoverable amount is 70 lakh. How much is the book value is coming? The 50 plus 10 plus 20, that is coming a 50 plus 10 plus 20, that is coming how much? 80 lakh. 80 lakh if I minus the recoverable amount is how much? Is 70 lakh that year. So we have an impairment loss of 10 lakh. But how to distribute this 10 lakh? Because this 10 lakh does not belong to one particular asset that year. So we are going to distribute on the basis of their book value. So their book value is how much? 50, 10 and 20. So this will be distributed in the proportion of 50, 10 and 20, and these are the impairment. First we find the impairment loss of the group, and then on the basis of their book value we will allocate them. Okay, so you can see that 6,25,000, 1,25,000, 2,50,000. 6,25,000, 1,25,000 and 2,50,000. Okay, now here second concept, the corporate asset. Corporate asset means basically it is an asset which is using by separate CGO, different CGO. CGO is a group of assets. For example, I have a building. It is used by cloth department as well as the ready-made department. So it is a CGO of some assets and these are CGO, but this particular building is used by different cash generating units at here. So they say corporate asset here don't generate independent cash flow. They are not individually, they are not generating cash flow. The different CGOs are using it to generate the cash flow. So they say their carrying amount cannot be fully attributed to a specific CGO. So these building does not belong to one CGO. It belongs to separate different CGOs. So how to do that? They say example, they have given certain example. They say the headquarter building EDP like electronic data processing equipment and a research center are example of corporate asset. They don't generate cash independently and their value can't be entirely attributable to a specific CGO. So how to allocate? The problem is that I have one building which is using a different CGO. I have to allocate the value of those buildings to find it out the impairment loss. So there are two methods. First is the bottom up test method. And second is the bottom up and top down test. Not technical word, but very simple. If you can allocate, if I know that here now, how much is building, if I know that here, how much this building is used by the cloth department and the ready-made department, then I'm going to use the first approach, the bottom up test. I can allocate a reasonably and consistently. First, take an example on it. If I say that I have a two CGO, CGO A, their book value is 4 lakh, CGO B, their book value is also 4 lakh. Now I have a one corporate asset, their value is how much? Let's say that here 4 lakh. I can reasonably know that 50% if used by the A and 50% used by B. I can allocate that here. Okay, one floor is used by CGU A, one floor is used by CGU B. So if I know that on the basis of square meter, whatever that, if you know reasonably, you can allocate the value. So I say suppose 50%. So that's come 2 lakh. So now total value is coming 4 plus 2, 6, here also 6. Now what is the recoverable amount of CGU1 is 8 lakh and here 5 lakh. So what is the formula of impairment loss? Carrying amount minus recoverable amount. So this is the carrying amount is 6 lakh, recoverable amount is 8 lakh. So there is no impairment loss here. Here the carrying amount is 6 lakh, recoverable amount is 5 lakh. So there is an impairment loss of 1 lakh. But how to allocate this 1 lakh? Because the 1 lakh is the impairment loss that I have to allocate in a carrying amount of the CGU as well as the corporate asset. So how will I allocate in the proportion of their book value? So they say impairment loss will be allocated to the CGU and the corporate asset. How to allocate? 1 lakh divided in the ratio of 4:2. Divided by 4 multiplied by 2. This amount will come and divided by 6 divided by 6 multiplied by 4. And here divided by 6 multiplied by 2. So we allocate in the proportion of what? Their carrying amount. Simple. Now if I cannot allocate the value of the corporate asset, can reasonably between the different CGOs, then there is a method we call it bottom up and the top down test. What it says that now here in this they first apply the bottom up testing the individually for each CGO and then conduct the top down test, calculate the corporate asset impairment loss by aggregating all CGOs and corporate asset. Now simple, listen carefully. They say suppose I have now they say first they say as a group calculate how much the carrying amount of CGO A is a 4 lakh. Okay, I will come to group later. First, they say individually. I'm going to forget about the corporate asset because I cannot allocate the value of the corporate asset. So forget about the corporate asset timing. I don't know any corporate asset. So individually for the CGs, we will calculate the impairment loss. So carrying amount is 4 lakh, carrying amount is 4 lakh and recoverable amount is 8 lakh. How much is the impairment loss? There is no impairment loss because when the carrying amount is more than the recoverable amount, then only we have impairment loss. Here it is 4 lakh minus 5 lakh. Is there an impairment loss here? No. So when I calculate individually without, forget about the corporate asset. So when I calculate a impairment loss for the CGO A and CGO B, there is no impairment loss. Now there is one corporate asset that I'm not able to allocate between the A and the B to CGO. So now what I do that I will make as a group now. First, individually calculate for the CGO, okay, as separately that is CGO A and the CGO B that here. Now what we'll do that now? Now there is no impairment loss. Now we'll make a group. So CGO A carrying amount is 4 lakh, B is 4 lakh, and suppose the building corporate asset also is 4 lakh. So carrying amount of all the CGO and the corporate asset is coming 12 lakh. And suppose the recoverable amount is 10 lakh. How much impairment loss I have? 2 lakh. Now this is very interesting. You will tell me, sir, as a group, if we make including the corporate asset, sir, we have a impairment loss of 2 lakh. Now, who is going to bear these 2 lakh? Because here, when the impairment loss come here, 1 lakh, it is distributed between CGU B and their corporate asset. Here, what about the 2 lakh? Who is going to bear? Not by any CGU. We'll say why, sir? Because here, when we calculate individually the impairment loss of the CGU, there was no loss to them. So these, we have already done the test of the impairment loss for the CGU individually. That so these here 2 lakh will be bear only by the corporate asset. So they say impairment loss will be allocated only to the corporate asset because CGU testing has already been completed. So first we have already calculated individually this impairment loss of those CGU. So they are not going to bear this impairment loss. That these 2 lakh will make a group. This 2 lakh is going to be bear by the corporate asset only. But 2 methods. First, the bottom up test, when we can reasonably allocate the price of the these corporate assets. So we will allocate them. We will calculate impairment loss. If loss comes, it is going to bear by both CGU and the corporate asset in their book value proportion. But in case of a bottom up and top down test, first we calculate individually for the CGU. Now then we calculate as a group. Okay, because we cannot allocate group. If impairment loss come, that it is going to bear only and only by the corporate asset, because we have already done the the impairment loss of these CGU and there was no impairment loss there. Okay. Now the next is the impairment of goodwill. So nothing is new in case of impairment of goodwill except one point. They say, just like the corporate asset, goodwill is also an asset that belongs to the different CGU. It's like a corporate asset because goodwill also belongs to different CGUs that year. Okay. So explanation should be followed for the goodwill as well. Same explanation. What we are discussing the corporate, same is going to be applicable here. But this, however, any impairment loss first should be allocated to goodwill and the remaining impairment loss should be allocated to CGU and the corporate asset. What they are saying that now, the treatment of the goodwill is same like the corporate asset. But there's the only difference is that if there is any impairment loss come, first impairment loss should be adjusted against the goodwill. Against the goodwill, then we'll go for the remaining asset. Okay. So let's take an example so it will be easy for you. They say here at the end of, okay, what they say that here now, at the end of 2020, Enterprise M acquired 100% of Enterprise Z for 3,000 lakhs. Z has three cash generating unit A, B and C with net fair value 1,200, 800 and 400 lakhs respectively. M recognized goodwill. How they have recognized the goodwill that here? They have recognized the goodwill that here now. What is the price that we have is a 3 lakhs, 3,000. Okay. Now here we purchase that value of the first is 1,200, 800 and 400. So we paid 3,000 that year. But if we take the value of those three, fair value of those three CGU, it is coming 1,200 plus 800, 2,000 plus 400, that is 2,400. So 3,000 minus 2,400, how much is the goodwill is recorded? You know the amalgamation chapter. Okay, this is what they have paid 3,000 in return, they get a net asset of 2,400. So this is a goodwill of 600 here. Okay. Now at the end of the 2024, after 4 years that year, okay, they say A. So how many units the CGU they purchased? 3. A, B, C. They're talking A. A makes a significant losses. Its recoverable amount estimated to be rupees 1,350 lakhs. Carrying amount are detailed below. So after 4 years, their carrying amount changes that year. A's carrying amount is 1,300, B's 1,200, C 800 and goodwill is appearing at 120. Okay, this is the carrying amount after 4 years. 600 when we purchase. Now what is the value after 4 years, beta? 120. The carrying amount change of CGU and the goodwill as well. This is the total carrying amount. Now the two situation will come when goodwill can be allocated on reasonable, like the corporate asset can be allocated on a reasonable and a consistent basis, and where goodwill cannot be allocated on reasonable and consistent basis. If we can allocate the goodwill that here, how we calculate the corporate asset that here? Now we will allocate that here. Okay, so they say here on the date of the acquisition of Z, the net fair value of A, B and C are considered reasonably basis for a pro rata allocation of the goodwill between A, B and C. Now understand, what is the net fair value when we purchase in 2020 beta? That is the 1,200, 800 and 400. So they say allocate that here. Okay, allocate on the basis of the fair value. So it was their fair value. So when I'm to allocate the goodwill of this 120 here, so I will allocate here in these proportion 50%, 33.3, 16.5. So we allocate these, or you can say that in this proportion 12:8:4. So we allocate 12:8:4. This is the on a pro rata we allocate the goodwill. But the book value also changed for the ABC carrying amount is 1,300, 1,200 and 800. So 1,300, 1,200, 800. So this is the value that they have of the carrying amount. This is the value of the goodwill. If you do the total of these two, that is coming 3,420. Okay. Now understand what is the net carrying amount after considering the goodwill 3,420. Now they say, if we talk about that, it is individual that they have allocated, but here they are only talking about the impairment loss of A. So when I say that about the A, that here now, what is the book value for A? Sorry, what is the book value for A here? That is coming 1360. Now what is the here the recoverable amount 1350? They're talking about A only. So we allocate the goodwill. We can allocate on the proportion of their book value. Now when they say 1360, it is a book value carrying amount, and so impairment loss, when I say carrying amount minus recoverable amount, that is coming here, carrying amount is 1360 minus 1350. So we have an impairment loss of 10. So when I say impairment loss of 10, who is going to bear this impairment loss of 10? Will it be allocated at 10 in the ratio of 1300 and the 60? No. These 10 is first, always remember, first it should be allocated to goodwill only. So this impairment loss will be bear by this goodwill, that is, these 60 only, that is. What they mention. So they say, I am recognized impairment loss of 10 lakh for A. The impairment loss is fully allocated to the goodwill in accordance with accounting standard 28. That okay. Now here I am coming to a point that here now next is, if goodwill cannot be allocated on a reasonable basis. So what we do that here now, first we calculate individually their impairment loss, if any. Okay. So what we'll do that individually, see that here. This is the carrying amount that they have. This is the carrying amount that they have here. Okay. Now, is there an impairment loss, that impairment loss arising from the bottom of test? If you see that individually, now let's take an example. What is the carrying amount of A? 1300. Okay. What is the recoverable amount? Exclude. We are not considering goodwill. Same like a corporate asset. In corporate, we don't consider corporate asset. We don't consider that the goodwill here. So there is no impairment loss. So individually there is no impairment loss. We are talking just A only. So there is no impairment loss here. So when I say this is the carrying amount is coming. Okay. Now what is the recoverable amount? That here recoverable amount is mentioned here, that is coming for the whole group, that is that's recoverable 3400. So 3400 we have an impairment loss of how much here? 20. Now who is going to bear by this 20? That here now we have impairment loss when we consider the group. So it is going to bear by the goodwill only. So this 20 will be adjusted, fully allocated to the goodwill. But what is the difference here? Here we calculate individually first, then we'll make as a group that. Okay, so the same treatment of the goodwill is like the corporate asset only. Only the difference is that in case of a impairment of goodwill, impairment when we do the goodwill, impairment loss first will be adjusted against the amount of goodwill. Okay, now I am coming to the next concept, allocation of impairment loss for cash generating unit. So you know that here when we talk about, if we have impairment loss, first we have to adjust against the goodwill, and for the remaining on a pro rata basis to other assets on the basis of the book value will allocate them. Remember that when we talk about the carrying amount should not, see, the carrying amount should not fall below the highest of this. So they are saying that, what does it mean? That is, suppose if I say that now, the carrying amount is coming, suppose 10 that now. And when I say the recoverable amount is the highest of the value in use and the net selling price, that is, suppose that is coming 8 that year. So how much impairment loss I have? I have impairment loss of 2 that is. So obviously that my carrying amount should not fall below the highest. I mean to say, if the recoverable amount is coming 10 that now, so my carrying amount cannot be less than the recoverable amount is coming 8, suppose that here. So my carrying amount is going to reduce by these 2 impairment loss, but it will still at the 8 only. So my carrying amount should not fall below the recoverable amount. Okay. Now here it says that here now. Here it says, okay, now the next is the reversal. So we recorded the impairment loss that we recorded the impairment loss, but can we reverse the impairment loss that later on? Yes, if my recoverable amount increases, that I will tell you how. This is general reversal. Assess at each balance sheet date for indicators of a decrease in the prior impairment loss. Reversal if estimate the cash flow discounted change in last recognition, increase in the book value. Simple that. If I have impairment loss, if later on we see that no, there is no impairment loss, increase it, reverse the entry. Initially pass P&L account debit to asset, now asset account debit to P&L, just reverse it. But individual asset reversal, then this general rule is point number B point. They say if you write it off to P&L account, recognize the income immediately. What they are saying, initially record P&L to asset, reverse asset to P&L. Case to initially adjust against the revaluation reserve. So write back to reserve and surplus as revenue. So you adjust first against the reserve that year. Okay. Just you have to reverse the entry what you have passed. Now one important point. They say the increased carrying amount of asset due to reversal should not exceed the amount that would have been determined net of depreciation had no impairment loss had been recognized previously. Any further increase governed by the AS10 revaluation reserve post the reversal depreciation charged to the latest carrying amount. Now, through an example only, you will be able to understand. Suppose you purchase a machinery by paying 50 lakh. Useful life, by mistake, it is written there rupees 10 years. That is not rupees, cut the rupees sign. Okay. What is the life of the asset? 10 years. Okay. At the end of the first year, indication of impairment exists. Suppose the recoverable amount is 36 at the end of the first year. So I say, what is the book value? 50 lakh I purchase. The depreciation life is 10 years. So depreciation for 1 year is 5. So 50 minus 5, that is coming how much? 45. What is the recoverable amount? 36. So I will deduct the recoverable amount. So I have an impairment loss of 9 lakhs. So I will pass entry penal account debit to PP account. Okay. Now, and second year, we are going to charge the depreciation on these 36 because we reduce the value. 45 it was at the end of the first year. We record the impairment loss. Now it is coming at 36. So 36 is the book value. The depreciation for the second year, the 36 divided by 9, that is coming 4 lakh. So the book value at the end of the second year is coming 32. Now the indications come that here. Now the latest recoverable amount is 50. Now we have to reverse it that. But how much we can reverse it that here? They say maximum that much we can reverse it. If suppose there is no depreciation, how much would be the book value? Let's take it, sorry. If there is no impairment loss, how much would be the value? Only up to that extent we can reverse it. They say reversal should be limited to the book value if no impairment occurred. Carrying amount that would be present if no impairment loss. Suppose there is no impairment loss. So first year we purchase a 50 lakh. First year depreciation 5 lakh. Second year depreciation will be 5 lakh. If there is no impairment. So today if there is no impairment, the value would be 40 lakh. But what is the value is appearing? 32. What would be the value if there is no impairment? 40. So this 8 lakh will be recorded only as the impairment loss. But the market value is what? The 50 that here. Market value is what? 50 that here. So this remaining 10 will be recorded the revaluation surplus as per accounting standard 10. This is what they are saying. So if there is no impairment, what will be the value and what is the value today? Only up to that extent we can reverse as per the AS28. Surplus amount, if any, that is going to be recorded the revaluation reserve as per accounting standard 10. Okay. Now they say when we do the reversal, cash generating unit reversal allocate to asset other than goodwill on a, remember goodwill generally not reverse. When I mean to say impairment loss happen, first we adjust against the goodwill bit. But when it's come to reversal, not recommended to adjust. We never, there's certain exception, but in general, we don't reverse, we don't increase the value of the goodwill. So first they say allocate to asset other than goodwill on a pro rata basis and then to goodwill. So goodwill reversal, no reversal for change in estimate, for example, change in the discount rate. Reversal only allow in goodwill if the impairment loss was caused by a specific external event of an exceptional nature and which is not expected to recur and subsequent external event have occurred that reversal affect to that event. So they say we are going to do the reversal to goodwill only if they're saying impairment loss was caused by a specific some external event happened which is exceptional nature that is not expected to recur and subsequent external event have occurred that reverse the effect of that event. So certain uncertain event happen that day which we are not expecting to happen. Only in that case we can adjust against the goodwill. Okay. So, but you know, in the whole discussion that here, you know what is important? Only 2 points. What is 2 points that here now? 2 points. This is how to calculate impairment loss and what should the treatment of the impairment loss. 99% IC is going to ask you question on these points. Okay. Now this is all about accounting standard 28. Not at all difficult. Just so many students asking me about these notes. You just have to purchase repeat this book, which is available at the Kaushik Sir the website. You can find it out there. Purchase this book there. It will help you to do the multiple time revision that is now. These I have already shared the super 100 question that is okay, and I have already covered the question of these AS28 as well there. Okay. And it will help you to do the multiple time revision before the examination. Okay, that is all about the accounting standard 28. That is impairment of. That is for today. Take care all of you. Bye bye.